Quiet meetings, confidential discussions, and now a decision rippling across North America. Canada, one of the United States' closest allies, is poised to strike back in ways that could reshape the U.S. economy for decades. Trade between these two nations has long been a cornerstone of stability, but a brewing storm threatens to redefine their economic relationship. With billions of dollars in trade on the line, the implications are global. What is Canada planning, and why are U.S. industries sounding alarms? Let's unravel the details. The roots of this conflict stretch back years, but Washington's recent tariff threats have pushed Canada to a breaking point. Multiple sources close to Canadian officials report that a broad retaliation strategy is under development behind closed doors. This isn't a narrow dispute over steel or aluminum. It's a comprehensive challenge aimed at key sectors of the U.S. economy. Canada views these tariffs not just as economic policies, but as a tax on its sovereignty and economic security. The U.S. has imposed or threatened duties on Canadian exports, including timber, agricultural products, and metals, citing trade imbalances and protectionism. In response, Canada is preparing a multifaceted retaliation plan. Early reports suggest tariffs on U.S.-made cars, orange juice, and even quintessential American goods like bourbon. These choices are not arbitrary. They are calculated moves designed to target industries in key swing states, sending a direct message to U.S. policymakers. Trade between the U.S. and Canada is enormous. In 2023 alone, the two nations exchanged goods and services worth over $800 billion. Canada is the largest export market for U.S. goods, and the U.S. is Canada's largest trading partner. These aren't just numbers. They represent jobs, livelihoods, and entire industries. Should Canada's retaliation materialize, U.S. exports could face billions in losses, with effects rippling through supply chains and local economies. Canada's leaders understand this is about more than economics. It's about politics. By targeting industries in states like Michigan, Florida, and Kentucky, Canada is amplifying the political stakes for U.S. decision-makers. The strategy isn't without risk, but for Canada, it's also a stand for sovereignty and economic resilience. Canadian officials are signaling to their citizens and the world that they will not be intimidated by their largest trading partner. For U.S. automakers, Canada's retaliation could be a nightmare. Tariffs on cars would disrupt tightly integrated supply chains that have defined North American manufacturing for decades. Meanwhile, U.S. farmers are bracing for potential devastation. Canada is a major buyer of U.S. agricultural products, and retaliatory tariffs on items like corn, soybeans, and orange juice could severely impact rural communities already grappling with rising costs and global competition. Beyond major industries, small businesses that rely on cross-border trade are also at risk. Canada, though smaller in population and GDP, holds significant leverage in sectors like energy. As the largest foreign supplier of oil, gas, and electricity to the U.S., Canada could escalate the dispute by restricting energy exports. While such a move hasn't been officially threatened, even the possibility could cause instability in American energy markets, particularly during winter months. This isn't the first time Canada has clashed with the United States over trade. During a 2018 tariff dispute, Canada imposed retaliatory duties on American steel, aluminum, and other goods. The result? U.S. manufacturers and farmers felt the pinch, prompting public outcry and a resolution. Learning from that experience, Canada's current plan appears more calculated, with broader implications for both economies. The U.S.-Mexico-Canada Agreement, or USMCA, designed to stabilize North American trade, is now under strain. If Canada's retaliation proceeds, it could trigger legal challenges under the agreement's dispute resolution mechanisms. This would exacerbate tensions, potentially undermining the pact's long-term viability and adding legal complexities to an already heated conflict. In Canada, this standoff isn't just about economics, it's about national pride. Many Canadians view U.S. trade policies as unfair and aggressive, and there is widespread public support for their government's firm stance. This domestic backing provides Canadian officials with the political capital needed to take bold actions, even at the risk of short-term economic pain. Globally, this dispute has broader implications. Other nations are closely watching Canada's response. If successful, it could inspire similar resistance to United States trade policies. Meanwhile, global markets are preparing for potential disruptions. A full-scale trade war between the United States and Canada could send shockwaves through supply chains, commodity prices, and investor confidence. Canada is also leveraging its position as a leading supplier of critical minerals like cobalt and nickel, materials essential for electric vehicle batteries and renewable energy technologies. Traditionally a major supplier to the United States, Canada is reportedly reconsidering its export policies. Should Canada restrict these exports or pivot toward other markets, such as China, it would force United States industries to scramble for alternatives, potentially slowing down America's clean energy transition. However, retaliation is not without its challenges. Canada's own industries could face economic pain as tariffs make certain exports less competitive in United States markets. Small Canadian businesses reliant on United States trade might struggle to stay afloat, and public support for aggressive measures could waver if job losses mount. Jennifer Collins, a Canadian small business owner who exports maple syrup to the United States, shared her concerns. "We understand the government's position, but losing access to our biggest market would devastate us." Energy remains a critical wildcard in this dispute. Canada's position as the largest foreign supplier of oil and gas to the United States gives it significant leverage. While Canada has not publicly threatened energy restrictions, even the hint of such a move could destabilize energy markets, triggering price spikes and shortages. This would amplify economic pressures, affecting consumer confidence and inflation rates. Internationally, Canada is seeking backing from organizations like the World Trade Organization, or WTO. By framing U.S. tariffs as violations of global trade agreements, Canada aims to rally support and isolate the United States diplomatically. If successful, the strategy could lead to punitive measures with international endorsement, putting additional pressure on Washington. The broader question is whether Canada and Mexico could deepen their trade ties to counterbalance U.S. dominance. Both nations have faced tariff threats from Washington, and shared experiences could foster closer cooperation. A stronger Canada-Mexico trade alliance would reduce reliance on the United States, creating new opportunities for economic growth while challenging America's dominant position in the region. U.S. officials are downplaying Canada's plans publicly, but concerns are mounting behind the scenes. Retaliatory tariffs could escalate into a tit-for-tat trade war, with far-reaching consequences for both nations. However, the U.S. also recognizes that alienating Canada, its largest trading partner and a critical ally, would be a grave mistake. This delicate balancing act will shape the coming weeks. Experts have weighed in on the unfolding crisis. Dr. Jane Smith, an economist at the University of Toronto, remarked in a recent interview with the Globe and Mail, "Canada's measured approach demonstrates not only its economic leverage, but also its strategic foresight. This isn't about retaliation for its own sake, it's about safeguarding long-term interests." Similarly, David Turner, a trade policy analyst at the Peterson Institute for International Economics, highlighted that the interconnected nature of U.S. and Canadian industries makes this dispute uniquely complex. Neither side can afford prolonged hostilities. At the consumer level, the potential fallout is significant. If Canada's tariffs include agricultural products, American households could see price hikes on everyday items like orange juice and maple syrup. A recent Wall Street Journal report projected that such measures could increase grocery bills by 5 to 8% in affected regions. Additionally, job losses in key sectors could ripple across small towns and border cities, where communities often depend on cross-border trade for economic survival. The impact on global markets also cannot be ignored. Historical precedents provide insight. In 2002, a US-EU trade conflict over steel tariffs led to widespread economic disruptions before being resolved through WTO mediation. Analysts suggest Canada's current strategy may follow a similar path, potentially resulting in temporary setbacks but long-term adjustments in global trade policies. Public opinion in Canada strongly supports a firm response. A recent Toronto Star poll revealed that 68% of Canadians back their government's stance, even if it results in economic hardship. Meanwhile, U.S. businesses are sounding alarms. John Miller, a Michigan-based auto supplier, emphasized, "We've built our business on cross-border partnerships. A prolonged trade war would be catastrophic. Not just for us, but for the entire region." The potential for diplomatic resolution remains, but it will require both sides to navigate complex domestic and international pressures. The next few weeks will be critical as policymakers weigh the costs of escalation against the benefits of compromise. How this standoff unfolds could redefine North American trade and set a precedent for future global disputes. If you found this breakdown insightful, let us know your thoughts in the comments below. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.